This is a basic futures trading tutorial. If you've ever wondered how to make money buying and selling pork bellies, gold, soybean oil, you've come to the right place. For this tutorial, we'll be using LimitUp Online, which is a futures trading simulator. It's a good choice for this exercise because it's free and you don't need to open a trading account. And LimitUp Online is in fact a game, not an actual trading tool on some brokerage website. So let's see if we can make some money. I've logged on to limitup.com and it asks me if I want to sign in, register as a new user, or simply play as a guest. I'm just going to play as a guest. LimitUp Online builds a guest account for me, and I'm going over this login process with you in case you want to try this yourself at a later time. Or you can follow along right now in a separate browser window. Okay, so here we are at the main screen. If you're following along and you've never played LimitUp Online, start by clicking the day jump icon over here. Each click advances the session by 1 day. LimitUp uses historical data, so you can easily compress time and do a lot of trading in a fraction of real time, which is what we're going to be doing. All right, in the left column, there's a list of all of the available contracts. Since the point of this tutorial is to try to make money, let's find a contract that's hitting a low point on its chart. Okay, here's a good candidate. We can see by the daily chart that it's currently trading near the bottom of its range, and we actually have some funds in our account that we can trade with. So let's go to the trading desk and place an order. The rule of thumb is to buy low and sell high. You must have heard that many times before. So we're going to buy one contract of December 96 corn. Next, we want to specify the type of order and the price we want to pay. Prices are staying within a relatively narrow range, so let's keep it simple and make this a market order. That means we'll buy it at whatever the current market price happens to be. I click day because I want it only if I can buy it today, so the order is good for a day. These green check marks tell me that all of my input is correct, and my virtual broker has just sent me a message with a verbal confirmation of my order. If this were a real trade, this would be exactly what you tell your broker. He or she would then repeat back to you your order to confirm it. It's all good, so let's submit the order. It appears to have been accepted, and here it is in the Open Orders panel. Notice that we intend to go long on the contract, meaning it's a contract to buy something. A contract to sell is called going short. And there it goes, and now we go to the held positions window, and there it is. We now own one contract of December 96 corn, 5,000 bushels of corn, no less, at a price of $335.75, which is actually $3.3575 per bushel. So the broker is now holding $1,215 from our trading account, and that's just a security against the purchase, and we get that back at the end of this whole thing. We'll talk about the whole concept of leveraging in a future tutorial. For now, I want to concentrate on just this trade. So if we stop right here and do nothing else, then we can expect a delivery of 5,000 bushels of corn around January 1997. And a bill for a staggering $16,787.50. That's the price we paid times the number of bushels we bought, which is great if you're in the cereal business, but what we really want to do is to turn around and sell our corn contract for more than we paid for it. We need to do this before the contract delivery date, or else we'll need to build a corn silo in the backyard. In the real world, all we can do is watch and wait, watch and wait. In the LimitUp world, we have the ability to speed up time. We can advance 10 minutes at a time or a whole day at a time. So let's just click the day jump icon a few times until we see the price of corn start to go up. We may need to refresh the page to give LimitUp a chance to catch up with us. On day 9, we see a significant uptick. On day 10, there's another. Is this a good time to sell? Perhaps. We're at the start of day 11, and we see that the price closed yesterday at $352.75. We really don't know which way the market will go, but it's risen enough where it's not likely that the price will fall below our purchase price if we sell it early enough in the session. Again, our purchase price was $335.75, so we just want to sell it for more than that. So now let's go back to the trading window and place an order to sell or go short on this contract. The way the futures markets work, we're actually obtaining a new contract to sell the same amount of corn on the same delivery date. So we're actually buying 5,000 bushels and we're turning around and selling that same 5,000 bushels. When it comes time to fill this order, the new short position will cancel out the old long position. The sell will cancel out the buy. And the difference between the two prices is our profit or our loss. Let's go to the transaction history window so that we can see what's going on. Along with our previous transactions, we can see the current open order. In a few moments, that order will be filled by the exchange, and the net result will be that the long position we obtained on day 7 gets closed out. And there it goes. We just sold a contract for $349. It's not quite as high as the $352.75 that it closed at yesterday, day 10, but that's the way it goes. At least we turned a profit. Up here in our account history, you can see that the money has been added to our trading account. So let's do a recap of the math. We went long on 5,000 bushels of December 96 corn at $335.75. After 4 days, we went short on 5,000 bushels of December 96 corn, and the price was $349. So we bought it at $335.75, and we sold it at $349. Easy so far? Subtract the long position from the short position to get the change in price, which is $13.25. That's 13 and 1/4 cent. And yep, that's our gain, 13 and 1/4 cents. But that's the gain per bushel. The contract is for 5,000 bushels, so we multiply that gain by 5,000, and we come out with $662.50. Whoa, that's more like it. The miracle of leveraging. We then subtract the broker fee, which is $30 in this case, and get the net profit of $632.50. Add that to our original balance of $13,169, which is what we had in the account when we first logged in, and we now have $13,801.50. Pretty good profit for not much work. Had we bought 10 contracts doing the exact same amount of work, we would have made $6,325. In a future tutorial, I'll explain where this money came from, given that you only gave a security deposit of $1,215, which you get back anyway at the end of the transaction. For now, I think we've discussed enough for you to try a few transactions on your own. I use limituponline.com in this demonstration because it's fast, it's easy, and it's free, and you don't need to open an account. And it's the most fun you'll have trading futures with someone else's money.